Interest income. It is the amount of compensation paid for the use of money or forbearance from such use. Tax-exempt interest income. 1. From bank deposits, the recipient must be any following tax-exempt recipients. A. Foreign government. B. Financing institutions owned, controlled, or financed by foreign government. 3. Regional or international financing institutions established by foreign government. 3. On loans extended by any of the above-mentioned entities. 4. On bonds, debentures, and other certificate of indebtedness received by any of the above-mentioned entities. 5. On bank deposit maintained under the expanded foreign currency deposit. 6. From long-term investment or deposit with a maturity period of 5 years or more. Note: in order to avail the exemption under item number 4, the recipient must be a non-resident alien or non-resident foreign corporation. Otherwise, it is subject to final tax of 7.5%. Long-term deposits or investments, certificate of time deposit or investment in the form of savings, common or individual trust funds, deposit substitutes, investment management accounts, or other investments with maturity of not less than 5 years, the form of which shall be prescribed by the Bangko Sentral ng Pilipinas (BSP) and issued by banks, not by non-bank, financial intermediaries, and finance companies, to individuals in denominations of 10,000 and other denominations as may be prescribed by the BSP. Deposit substitute. This is an alternative form of obtaining funds from the public other than deposit through issuance, endorsement, or acceptance of debt instruments for the borrower's own account for the purpose of relending or purchasing of receivables and other obligations, or financing their own needs or the needs of their agent or dealer. In order for an instrument to qualify as a deposit substitute, the borrowing must be made from 20 or more individual or corporate lenders at any one time. The mere flotation of a debt instrument is not considered to be a public borrowing and is not deemed a deposit substitute if there are only 19 or less individual or corporate lenders at any one time. Foreign currency deposit system. It refers to the conduct of banking transactions whereby any person, whether natural or juridical, may deposit foreign currencies forming part of the Philippine International Reserves in accordance with the provisions of RA 6426, an act instituting a foreign currency deposit system in the Philippines, and for other purposes. Interest income subject to 7.5 final tax. If the interest is received by the individual taxpayer except non-resident individual from a depository bank under the expanded foreign currency deposit system, it shall be subject to a final tax at the rate of 7.5% of such income. NIRC Section 24. Non-resident citizen and non-resident alien are exempt from payment of the 7.5 final tax on interest income under the expanded foreign currency deposit system. Meanwhile, interest income derived by domestic corporation and resident foreign corporation from a depository bank under the expanded foreign currency deposit system shall be subject to final income tax rate of 7.5%. Correspondingly, interest income received by NRFC shall be exempt. Q. Is the interest income of NRFC under EFCDS subject to final income tax of 7.5%? No. Any interest income derived from non-residents, whether individuals or corporations, from transactions with depository banks under the expanded foreign currency deposit system shall be exempt from income tax. EFCDS is expanded foreign currency deposit system. NRFC is non-resident foreign corporation. Interest income subject to 10% final tax. Interest derived from foreign currency loans granted by depository banks to residents, DC or RFC, other than offshore banking units in the Philippines, or other depository banks under the expanded system shall be subject to 10% final tax. Note: if the loan is granted to non-resident, OBUS or local commercial banks, including branches of foreign banks authorized by the BSP to transact business, it shall be exempt. Interest income subject to final withholding tax, 20% versus income subject to gross receipts, tax 5% on banks. 20% final withholding tax on interest income. It is an income tax under Title II of the NIRC, Tax on Income. Final withholding tax is imposed on the gross interest income realized in a taxable year. Final withholding tax is subject to withholding. 5% gross receipts, tax on banks. It is a business tax, percentage tax, under Title V, other percentage taxes. Gross receipts tax, GRT, is measured by a certain percentage on the gross receipts or earnings. GRT is not subject to withholding. Note, the 20% final tax withheld on a bank's passive income should be included in the computation of GRT. China Banking Corporation versus CIR. Q. Maribel, a retired public school teacher, relies on her pension from the GSIS and the interest income from a time deposit of $500,000 with ABC Bank. Is Maribel liable to pay any tax on her income? Yes. Maribel is exempt from tax on the pension from the GSIS. However, with her time deposit, the interest she receives thereon is subject to 20% final withholding tax. Q. In 2007, spouses Renato and Judy Garcia opened peso and dollar deposits at the Philippine branch of the Hong Kong Bank in Manila. Renato is an overseas worker in Hong Kong, while Judy lives and works in Manila. During the year, the bank paid interest income of $10,000 on the peso deposit and $1,000 on the dollar deposit. The bank withheld final income tax equivalent to 20% of the entire interest income and remitted the same to the BIR. A. Are the interest incomes on the bank deposits of spouses Renato and Judy Garcia subject to income tax? B. Is the bank correct in withholding the 20% final tax on the entire interest income? Answer to letter A. Yes. The interest income from the peso bank deposit is subject to 20% final withholding tax. The interest income from the dollar deposit is subject to 7.5% final withholding tax, but only on the portion of the interest attributable to Judy of $500. The interest on the dollar deposit attributed to Renato, a non-resident, is exempt from income tax. Answer to letter B. No. Only the interest income on a peso deposit is subject to 20%. The interest income from a dollar deposit is subject to 7.5% if the earner is a resident individual. Q. What is the tax treatment of the following interest on deposits with A. BPI Family Bank, B. A local offshore banking unit of a foreign bank? Answer to letter A. It is a passive income subject to withholding tax rate of 20%. Letter B. It is a passive income subject to final withholding tax rate of 7.5%. Both interests are not to be declared as part of gross income in the income tax return. Dividend income. Dividend is any distribution made by a corporation to its shareholders out of its earnings or profits and payable to its shareholders, whether in money or in any other property. Note, if dividends, whether cash or stock, are given to shareholders not as a return on investment, but in payment of services rendered, then they are taxable as part of compensation income or income derived from self-employment or exercise of profession, not as passive income. Kinds of dividends. Cash dividend, paid in given sum of money. Property dividend, one paid in corporate property such as bonds, securities, or stock investments, held by the corporation, not its own stock. They are taxable to the extent of the fair market value of the property received at the time of distribution. 3. Stock dividend, one paid by a corporation with its own stock. Stock dividends, strictly speaking, represents capital and do not constitute income to its recipient, so that the mere issuance thereof is not subject to income tax, as they are nothing but enrichment through increase in value of capital investment. In the loose sense, stock dividends issued by the corporation are considered unrealized gain and cannot be subjected to income tax until that gain has been realized. Before their realization, stock dividends are nothing but a representation of an interest in the corporate properties. Exceptions: change in the stockholder's equity, right, or interest in the net asset of the corporation. Recipient is other than the shareholder. 3. Cancellation or redemption of shares of stock. 4. Distribution treasury shares. 5. Dividends declared in the guise of treasury stock dividend to avoid the effects of income taxation. And 6. Different classes of stock were issued. Note, a stock dividend does not constitute taxable income if the new shares did not confer new rights nor interest than those previously existing, and that the recipient owns the same proportionate interest in the net assets of the corporation. 4. Scrip dividend, one that is paid in the form of promissory note. 5. Indirect dividend, one made through the exercise of right or other means of payment, example, cancellation or condonation of indebtedness. 6. Liquidating dividend, one resulting from the distribution by a corporation of all its property or assets in complete liquidation or dissolution. I think that's complete. It is generally a return of capital and hence it is not income. However, it is taxable income with respect to the excess of amount received over cost of the shares unrendered. Intercorporate dividends. There is intercorporate dividend when the dividend is declared by one corporation and received by another corporation, which is the stockholder, to the former. The following rules shall apply. 1. Dividends received from DC. Dividends received by a DC and RFC from a domestic corporation shall not be subject to tax. Rationale. The law assumes that the dividends received will be incorporated to the capital, which will eventually be taxed when the corporation gets income from its use of the capital. B. Dividends received by a non-resident foreign corporation from a domestic corporation shall be subject to 15% final withholding tax. This is known as the tax-sparing rule. Tax-sparing rule. Under this rule, the dividends received shall be subject to 15% final withholding tax, provided that the country in which the corporation is domiciled either allows a tax credit of 15% against taxes due from the foreign corporation for taxes deemed paid, or does not impose income tax on such dividends. See IRS Wonder Philippines. Otherwise, the dividend shall be subject to 30%. The phrase deemed paid tax credit does not mean tax credit actually granted by the foreign country. There is no statutory provision or revenue regulation requiring actual grant. The 15% represents the difference between the NCIT of 30% on corporations and the 15% tax on dividends. Number 2. Dividends received from a foreign corporation. A. Dividends received by a DC from a foreign corporation shall be subject to 30% NCIT. B. Dividends received by RFC and NRFC from a foreign corporation shall be subject to 30% NICT if the income of the foreign corporation is derived from sources within the Philippines. If the said income is derived from sources outside the Philippines, the dividends received shall be exempt from tax. In determining whether income is derived from sources within or without the Philippines, the ratio of the foreign corporation's Philippines gross income to the word gross income within the 3-year period preceding the declaration of such dividend should be considered. Philippine gross income, word gross income, calls percent. Source of income. 1. Less than 50%, entirely without. 50 to 85%, proportionate, partly within, partly without. More than 85%, entirely within. Okay. Tax treatment of dividend income. Subject to basic tax. Dividends from foreign corporation share in the income of GPP. Subject to final tax. 1. Cash and or property dividends actually or constructively received by individuals from domestic corporation or from a joint stock company, insurance, or mutual fund company and regional operating headquarters of multinationals. 2. Intercorporate dividends received from domestic corporation by non-resident foreign corporation. 3. share of an individual in the distributable net income after tax of a partnership other than the 2BB, which he is a partner. 4. Share of an individual in the net income after tax of an association, joint account, or a joint venture or consortium, taxable as corporation for which he is a member or co-venture. Exempt from tax, intercorporate dividends received from domestic corporation by another domestic corporation and resident foreign corporation. Recipient: domestic corporation, resident foreign corporation, tax exempt. Resident corporation, non-resident corporation, resident alien, 10%. Non-resident alien, ETB, 20%. NRA and ETB, 25%. NRFC, 15% subject to allowance of tax credit. Dividend received from foreign corporation. Dividend received from foreign corporation is subject to Philippine income tax if at least 50% of the world total income of the foreign corporation must be derived from the Philippines for 3 years preceding the declaration of such dividend. Q. Does tax on income and dividends amount to double taxation? No. Tax on income is different from tax on dividend because they have different tax bases. Q. What are disguised dividends in income taxation? Disguised dividends are those income payments made by a domestic corporation which is a subsidiary of a non-resident foreign corporation to the latter ostensibly for services rendered by the latter to the former, but which payments are disproportionately larger than the actual value of the services rendered. In such case, the amount over and above the true value of the service rendered shall be treated as a dividend and shall be subjected to the corresponding tax on Philippine-sourced gross income. Example, royalty payments under a corresponding licensing agreement. Q. Suppose the creditor is a corporation and the debtor is its stockholder. What is the tax implication in case the debt is condoned by the corporation? Answer. This may take the form of indirect distribution of dividends by a corporation. On the part of the stockholder whose indebtedness has been condoned, he is subject to 10% final tax on the mass dividend payment. On the part of the corporation, said amount cannot be claimed as deduction. When the corporation declares dividends, it can be considered as interest on capital, therefore not deductible. Q. BBB Incorporated, a domestic corporation, enjoyed a particularly profitable year in 2014. In June 2015, its board of directors approved the distribution of cash dividends to its stockholders. BBB has individual and corporate stockholders. What is the tax treatment of the cash dividends received from BBB by the following stockholders? A. A resident citizen. B. Non-resident alien engaged in trade or business. C. Non-resident alien not engaged in trade or business. D. Domestic corporation. E. Non-resident foreign corporation. Answer. A. A final withholding tax of 10% shall be imposed upon cash dividends actually or constructively received by a resident citizen from BBB. Letter B. A final withholding tax of 20% shall be imposed upon the cash dividends actually or consecutively received by a non-resident alien engaged in trade or business from BBB. C. A final withholding tax of 25% of the entire income received from all sources within the Philippines, including the cash dividends received from BBB. D. Dividends received by a domestic corporation from another domestic corporation, such as BBB, shall not be subject to tax. E. Dividends received by a non-resident foreign corporation from a domestic corporation are generally subject to an income tax of 30% to be withheld at source. However, a final withholding tax of 15% is imposed on the amount of cash dividends received from a domestic corporation like BBB. If the tax-sparing rule applies, pursuant to this rule, the lower rate of tax would apply if the country in which the non-resident foreign corporation is domiciled would allow a tax credit against the tax due from it. Tax is deemed paid in the Philippines of 15%, representing the difference between the regular income tax rate and the preferential rule. Fred was a stockholder in the Philippine American Drug Company. Said corporation declared a stock dividend, and that a proportionate share of stock dividend was issued to Fred. The CIR demanded payment of income tax on the aforesaid dividends. Fred protested the assessment made against him and claimed that the stock dividends in question are not income but are capital and are therefore not subject to tax. Are tax dividends income? Answer no. Stock dividends are not income and are therefore not taxable as such. A stock dividend, when declared, is merely a certificate of stock which evidences the interest of the stockholder in the increased capital of the corporation. The declaration of stock dividend by a corporation involves no disbursement to the stockholder of accumulated earning, and the corporation parts with nothing to its stockholder. The property represented by a stock dividend is still that of the corporation and not of the stockholder. The stockholder has received nothing but a representation of an interest in the property of the corporation, and as a matter of fact, he may never receive anything depending upon the final outcome of the business of the corporation. Q. The JV was tasked to develop and manage FDC's 50% ownership of its PBCom office tower project, the project. FDC paid its subscription by executing a deed of assignment of its rights and interest in the project worth $5.7 million in favor of the JV. The BIR assessed deficiency income tax on the gain on the supposed dilution and or increase in the value of PFDC shareholdings in FAC. Did the BIR properly impute deficiency income taxes to FDC, which was supposedly incurred by it as a consequence of the dilution of its shares in FAC? Answer no. The mere appreciation of capital is not taxable. Gain is realized upon disposition. No deficiency income tax can be assessed in the gain on the supposed dilution and or increase in the value of FDC's shareholdings in FAC. CIR vs. Philinvest Development Corporation. Q. Is the redemption of stock of a corporation from its stockholders as well as the exchange of common with preferred shares considered as essentially equivalent to the distribution of taxable dividend, making the proceeds thereof taxable? Yes. The general rule states that a stock dividend representing the transfer of surplus to capital account shall not be subject to tax. However, if a corporation cancels or redeems stock issued as a dividend at such time and in such manner as to make the distribution and cancellation or redemption in whole or in part essentially equivalent to the distribution of a taxable dividend, the amount so distributed in redemption or cancellation of the stock shall be considered as taxable income to the extent it represents a distribution of earnings or profits accumulated. The redemption converts into money the stock dividends, which become a realized profit or gain and consequently the stockholder's separate property. Profits derived from the capital invested cannot escape income tax. As realized income, the proceeds of the redeemed stock dividends can be reached by income taxation, regardless of the existence of any business purpose for the redemption. CIR vs. CA. Royalty income. No definition was provided for royalty income under the NIRC. Nonetheless, Webster Dictionary defined the same as a share of the earnings as from invention, book or play, paid to the inventor, writer, etc. for the right to make, use, or publish the same. Moreover, in Universal Food Corporation vs. CA, it was defined to be the compensation for the use of a patented invention. Tax treatment of royalty income. Subject to 10% final tax. Royalties on books, other literary works, and musical composition from sources within the Philippines. Subject to 20% final tax. Royalties derived from sources within the Philippines other than royalties subject to 10% to final tax. Subject to basic tax. Royalties derived from RC and DC from sources within the Philippines. Resident corporation and domestic corporation. Rent versus royalty. Basis as to reporting. Rent must be reported as part of gross income. Royalty need not be reported since subject to final tax. As to tax rate, regular progressive tax if individual. Royalty, final tax. Rental income. Rental income is a fixed sum, either in cash or in property equivalent, to be paid at a definite period for the use or enjoyment of a thing or right. All rentals derived from lease of real estate or personal property, of copyrights, trademarks, patents, and natural resources under lease. Prepaid rent. Prepaid or advance rental is taxable income to the lessor in the year received. If received under a claim of right and without restriction as to its use, regardless of method of accounting employed, note, security deposit applied to the rental of terminal month or period of contract must be recognized as income at the time it is applied. The purpose of security deposit is to ensure contract compliance. It is not income to the lessor until the lessee violates any provision of the contract. Rent is subject to special rate. Those paid to non-resident owner or lessor of vessels chartered by Philippine national, 4.5% of gross rentals. Those paid to non-resident owner or lessor of aircraft, machineries, and other equipment, 7.5% of gross rental or fees. Items considered as additional rent income. Additional rent income may be grouped into two. Obligations of lessor to third parties assumed by the lessee. 1. Real estate taxes on leased premises. B. Insurance premiums paid by lessee on property. C. Dividends paid by lessee to stockholders of lessor corporation. D. Interest paid by lessee to holder of bonds issued by lessor corporation. Number 2. Value of permanent improvement made by lessee on leased property of the lessor upon expiration of the lease. Lease of personal property. Rental income on the lease of personal property located in the Philippines and paid to a non-resident taxpayer shall be taxed as follows. Vessel, 4.5%. NRA, 25%. Aircraft, machineries, and other equipment, NRC, 7.5%. NRA, 25%. Other assets, NRC, 30%. NRA, 25%. Tax treatment of leasehold improvements by lessee. Recognized methods in reporting the value of permanent improvement. Where the lease contract provides that the lessee will erect a permanent improvement on the rented property and after the term of the lease, the improvement shall become the property of the lessor may, at his option, report the income therefrom upon either of the following methods. 1. Outright method. The fair market value of the building or improvement shall be reported as additional rent income at the time when such building or improvements are completed. And 2. Spread out method. Allocate over the life of the lessee the estimated book value of such buildings or improvements at the termination of the lease and report as additional rent for each year of the lease an aliquot part thereof in addition to the regular rent income. Note, with the outright method, it would only be counted for one rental payment, unlike with the spread out method, it would be distributed to the remaining term of the lease contract. Q. X leased his vacant lot in Binondo to Y for a term of 10 years at an annual rental of $600,000. The contract provides that Y will put up a building on the lot, and after 10 years, the building will belong to X. The building was erected at the cost of $6 million and has an estimated useful life of 30 years. Assuming the fair value of the completed building is the same as the construction cost, what is the total income of X if he opts to report his income on the leasehold improvement using C. Outright method, D. Spread out method? Answer D. If X reports his income on the improvements in the year it was completed, his total rental income shall be $6.6 million. E. If X reports his income on the improvements using the spread out method, his total rental income shall be cost of the building, $6 million, less accumulated depreciation at the end of the lease term. So $6 million divided by 30 years times 10 years, that's $2 million. Book value of the building at the expiration of lease, like $4 million, divide by lease term, 10 years. So the annual income of X on the improvement is $400,000, regular rental income of $600,000, so the total annual rental income is $1 million. For the answer to letter D, which is $6.6 million, $6 million is for the fair market value of the building in the year of completion, and we add annual rental of $600,000. Total rental income is $6.6 million. Tax treatment of advance rental or long-term lease. If the advance payment by the lessee is really a loan to the lessor or an option money for the property or a security deposit for the faithful performance of certain obligations of the lessor realizes no taxable income in the year the advance payment is received. If the advance payment is, in fact, a prepaid rental, there is taxable income to the lessor whether the latter is using the cash or actual method of accounting. Forms of advance payment: a loan to the lessor from the lessee. Tax treatment: general rule, non-taxable exemption if the lessee violates the term of the contract. An option money for the property. General rule, non-taxable exception if the lessee violates the terms of the contract. A security deposit to ensure the faithful performance of the lessee. General rule, non-taxable exception if the lessee violates the terms of the contract. A security deposit which restricts the lessor as to its use. General rule, non-taxable exception: security deposit applied to rental shall be subject to VAT at the time of its application. When taxable, taxable at the time it is applied. Prepaid rental without restriction as to its use. Taxable. When taxable, in the year it is received, irrespective of the accounting method employed by the lessor. Prices and awards. It refers to amount of money in cash or in kind received by chance or through luck and are generally taxable, except if specifically mentioned under the exclusion from computation of gross income under Section 32. Tax treatment for prices and winnings. Generally, prices exceeding $10,000 and other winnings from sources within the Philippines shall be subject to 20% final withholding tax if received by a citizen, resident alien, or non-resident engaged in trade or business in the Philippines. If the recipient is a non-resident alien not engaged in trade or business in the Philippines, the prices and other winnings shall be subject to 25% final withholding tax. If the recipient is a corporation, domestic or foreign, the prices and other winnings are added to the corporation's operating income, and the net income is subject to 30% corporate income tax. Recipient: citizen, resident alien, or non-resident engaged in trade or business in the Philippines. Tax rate subject to 20% final withholding tax. Non-resident alien not engaged in trade or business in the Philippines, subject to 25% final withholding tax. Corporation, domestic or foreign, subject to 30% corporate income tax. 2025-30. Prices and winnings subject to income tax. 1. Prices derived from sources within the Philippines not exceeding $10,000 are included in the gross income. 2. Winnings derived from sources within the Philippines is subject to final tax on passive income, except PCSO and Lotto winnings, which are tax-exempt. 3. Prices and winnings from sources outside the Philippines. Prices and awards exempt from income tax. 1. Prices and awards made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievement, provided the following conditions are met. A. The recipient was selected without any action on his part to enter the contest or proceeding. And B. The recipient is not required to render substantial future services as a condition to receiving the prize or award. Number 2. All prizes and awards granted to athletes in local and international sport competitions and tournaments, whether held in the Philippines or abroad, are sanctioned by their national sports associations. Note: the National Sports Association referred to by law that should sanction said sport activity is the Philippine Olympic Committee. 3. Prizes that winning inventors receive from the nationwide contest for the most innovative new and renewable energy systems jointly sponsored by the PNOC and other organizations during the first 10 years reckoned from the date of the first sale of the invented products, provided that such sale does not exceed $200,000 during any 12-month period. Summary of tax treatment of prices and other winnings. Exempt from tax. Prices and award made primarily in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievement, provided the recipient was A. Selected without any action on his part to enter the contest or proceeding, not constituting gains from labor, and B. Not required to render substantial future services as a condition to receive the prize or award. 2. All prizes and awards granted to athletes in local and international sports competitions and tournaments, whether held in the Philippines or abroad, and sanctioned by the respective National Sports Association. 3. PSCSO, Lotto winnings except NRA, NETB. Subject to basic tax. Prices and other winnings derived by resident citizens and domestic corporation from sources without the Philippines. Prices and winnings received by corporation from sources within the Philippines. Prices received by individuals from sources within the Philippines amounting to 10,000 or less. Subject to 20% final tax. Prices received by individuals except NRA and ETB from sources within Philippines exceeding 10,000. Other winnings from sources within the Philippines regardless of amount other than PCSO and lotto winnings. Subject to 25 final tax. Prices and other winnings including PCSO and lotto winnings received by NRA and ETB. Annuities proceeds from life insurance and other types of insurance. Annuity or annuity. It refers to the periodic installment payments of income or pension by insurance companies during the life of a person or for a guaranteed fixed period of time, whichever is longer, in consideration of capital paid by him. The portion representing return of premium is not taxable, while that portion that represents interest is taxable. Note, the portion of annuity net of premiums is taxable being interest or earnings of the premium and not return of capital. Q. X. Purchase life annuity for 100,000 pesos, which will pay him 10,000 a year. The life expectancy of X is 12 years. How much is excluded from the gross income of X? Answer. The 100,000 is excluded from the gross income of X since it represents a return of premiums, which is not income but a return of capital. Proceeds of life insurance. General rule. Amounts received under a life insurance, endowment, or annuity contract, whether in a single sum or in installments, paid to the beneficiaries upon the death of the insured, are excluded from the gross income of the beneficiary, exception if such amounts, when added to amounts already received before the taxable year, under such contract, exceed the aggregate premiums or considerations paid, the excess shall be included in the gross income. Note, however, in the case of a transfer for a valuable consideration by assignment or otherwise of a life insurance, endowment or annuity, contract, or any interest therein, only the actual value of such consideration and the amount of the premiums and other sums subsequently paid by the transferee are exempt from taxation. 2. Interest payments thereon, if such amounts are held by the insurer under an agreement to pay interest, shall be taxable. If paid to a transferee for a valuable consideration, the proceeds are not exempt. Note, the life insurance proceeds must be paid by reason of the death of the insured. Payments for reasons other than death are subject to tax up to the excess of the premiums paid. Any policy loans or borrowing made on the policy shall be deducted as advances from the life insurance proceeds received upon death. Recipients of non-taxable life insurance proceeds. Proceeds of life insurance policies paid to individual beneficiaries upon the death of the insured are exempt. Also, it has also been held that proceeds of life insurance policies taken by a corporation in the life of an executive to indemnify it against loss in case of his death do not constitute taxable income. Difference between the tax treatment of life insurance proceeds under income and estate taxation. In estate taxation, the concept of revocability or irrevocability in the designation of the beneficiary is necessary to determine whether the life insurance proceeds are included in the gross estate or not. However, if the appointed beneficiary is the estate, executor, or administrator, the proceeds shall be included from the gross estate. Note, under the insurance code, the insured shall have the right to change the beneficiary he designated in the policy unless he has expressly waived this right in said policy. Notwithstanding the foregoing, in the event the insured does not change the beneficiary during his lifetime, the designation shall be deemed irrevocable. On the other hand, in income taxation, there is no need for the determination of revocability or irrevocability of the beneficiary for purposes of exclusion of such proceeds from the gross income. They are non-taxable regardless of who the recipient is. Q. ABC Corporation took 2 insurance policies covering the life of its employees, Y. The first insurance designated W, wife of Y, as the beneficiary, while in the second insurance it was ABC Corporation which was the designated as the irrevocable beneficiary. In both insurances, it was ABC Corporation paying the premiums. Y died. Do the proceeds from part of the taxable income of the recipient? Are the proceeds part of the taxable estate of the deceased? Answer to letter A, no. The proceeds are not part of the taxable income of the recipient. Section 32, letter B, number 1 expressly excludes from income taxation proceeds of life insurance. This is based on the theory that such proceeds for income tax purposes are considered as form of indemnity, thus they are non-taxable regardless of who the recipient is. Answer to letter B, no. The proceeds of the 2 policies are excluded as part of the gross estate. For estate tax purposes, the determining factor on whether the proceeds of insurance shall be excluded in the gross estate is when the designation of the beneficiary is made irrevocable. Pursuant to the amendment introduced by RA 10607, approved on August 15, 2013, the second paragraph of Section 11 of the Insurance Code now reads, notwithstanding the foregoing, in the event the insured does not change the beneficiary during his lifetime, the designation shall be deemed irrevocable. Thus, since Y did not exercise his right to change W as his beneficiary, the designation is deemed irrevocable and hence the proceeds of the insurance not taxable. Pensions, retirement benefits, or separation pay. It refers to amount of money received in lump sum or in staggered basis, consideration of services rendered given after an individual reaches the age of retirement. Pension, being part of gross income, is taxable to the extent of the amount received, except if there is a BIR-approved pension plan. The amounts that do not qualify exclusions are considered as part of income subject to tax. Income from any whatever source. Income from whatever source derived implies that all income not expressly exempted from the class of taxable income under our laws form part of the taxable income, irrespective of the voluntary or involuntary action of the taxpayer in producing the income. The source of the income may be legal or illegal. Examples of income from whatever source derived, which form part of the taxable income of the taxpayer: 1. Gains arising from expropriation of property, which would be considered as income from dealings in property. Number 2, gains from gambling. 3, gains from embezzlement or stealing money. 4, gains, money, or otherwise derived from extortion, illegal gambling, bribery, graft and corruption, kidnapping, racketeering, etc. Rationale, these are taxable because title is merely voidable. 5. In stock options, the difference between the fair market value of the shares of the time the option is exercised and the option price constitutes additional compensation income to the employee, money received under solutio indebiti. Rationale, under the claim of right doctrine, the recipient, even if he has the obligation to return the same, has a voidable title to the money received through mistake. Number 7. Condonation of indebtedness for consideration. Rationale, this is because when a creditor cancels a debt as part of a business transaction, the debtor is enriched or receives financial advantages, thereby increasing its net assets and thus realizes taxable income. Forgiveness of indebtedness. Tax treatment for forgiveness of indebtedness. 1. When cancellation of debt is income, if an individual performs services for a creditor who, in consideration thereof, cancels the debt, it is income to the extent of the amount realized by the debtor as compensation for his services. Number 2. When cancellation of debt is a gift. If a creditor merely desires to benefit a debtor and without any consideration, therefore, cancels the amount of the debt, it is a gift from the creditor to the debtor and need not be included in the latter's income. The creditor is subject to donor's tax. 3. When cancellation of debt is a capital transaction, if a corporation to which a stockholder is indebted forgives the debt, the transaction has the effect of payment of a dividend. 4. An insolvent debtor does not realize taxable income from the cancellation or forgiveness. 5. The insolvent debtor realizes income resulting from the cancellation or forgiveness of indebtedness when he becomes solvent. Q. Mr. Gupit borrowed from Mr. Maunawain 100,000 payable in 5 equal monthly installments. Before the first installment became due, Mr. Gupit rendered general cleaning services in the entire office building of Mr. Maunawain, and as compensation therefore, Mr. Maunawain canceled the indebtedness of Mr. Gupit up to the amount of 75,000. Mr. Gupit claims that the cancellation of his indebtedness cannot be considered as gain on his part, which must be subject to income tax, because according to him, he did not actually receive payment from Mr. Maunawain for the general cleaning services. Is Mr. Gupit correct? No. Section 50 of Regs number 2, otherwise known as Income Tax Regulation, provides that if a debtor performs services for a creditor who cancels the debt in consideration for such services, the debtor realizes income to that amount as compensation for his services in the given problem. The cancellation of Mr. Gupit's indebtedness up to the amount of 75,000 gave rise to compensation income subject to income tax, since Mr. Maunawain condoned such amount as consideration for the general cleaning services rendered by Mr. Gupit. Recovery of accounts previously written off, when taxable or when not taxable. Tax benefit rule or equitable doctrine of tax benefit. It is a principle that if taxpayer recovers a loss or expense that was deducted in a previous year, the recovery must be included in the current year's gross income to the extent that it was previously deducted. 2 instances where tax benefit rule applies. Recovery of bad debts. 2. Receipt of tax refund or credit. Recovery of bad debts. The recovery of bad debts previously allowed as deduction in the preceding year or years shall be included as part of the taxpayer's gross income in the year of such recovery to the extent of the income tax benefit of said deduction. If the taxpayer did not benefit from deduction of the bad debt written off because it did not result in any reduction of his income tax in the year of such deduction, as in the case where the result of the taxpayer's business operation was a net loss, even without deduction of the bad debts written off, his subsequent recovery thereof shall be treated as a mere recovery or return of capital, hence not treated as receipt of realized taxable income. Receipt of tax refunds or credit. If a taxpayer receives a tax credit certificate or refund for erroneously paid tax which was claimed as a deduction from his gross income that resulted in a lower net taxable income or a higher net operating loss that was carried over to the succeeding taxable year, he realizes taxable income that must be included in his income tax return in the year of receipt. Exception. The foregoing principle does not apply to tax credit or refunds of the following taxes, since these are not deductible from gross income. A. Income tax. B. State tax. C. Donor's tax. And D. Special assessment. General rule on taxation of debts. Borrowed money is not part of taxable income because it has to be repaid by the debtor. On the other hand, the creditor does not receive any income upon payment because it is merely a return of the investment. James Doctrine. This doctrine provides that even though the law imposes a legal obligation upon an embezzler or thief to repay the funds, the embezzled or stolen money still forms part of the gross income, since the embezzler or thief has no intention of repaying the money. Proceeds of stolen or embezzled property are taxable. The money or other proceeds of the sale or other disposition of stolen property is subject to income tax because the proceeds are received under a claim of right. Source rule in determining income from within and without. The following are considered as income from sources within the Philippines. Interest. Residence of the debtor. The residence of the obligor who pays the interest rather than the physical location of the securities, bonds or notes, or the place of payment is a determining factor of the source of interest income. If the obligor or debtor is a resident of the Philippines, the interest income is treated as income from within the Philippines. National Development Company versus CAR. Number 2. Dividends. Residents of the corporation paying the dividends. Dividends received from a domestic corporation or from a foreign corporation are treated as income from sources within the Philippines, unless less than 50% of the gross income of the foreign corporation for the 3-year period preceding the declaration of such dividends was derived from sources within the Philippines, in which case only the amount which bears the same ratio to such dividends as the gross income of the corporation for such period derived from sources within the Philippines bears to its gross income from all sources shall be treated as income from sources within the Philippines. 3. Services. Place of performance of the service. If the service is performed in the Philippines, the income is treated as from sources within the Philippines, regardless of the residence of the payer, of the place in which the contract for service was made, or of the place of payment. 4. Rentals and royalties, location or use of the property or interest in such property. If the property is located or used in the Philippines, the rent or royalties are income from sources within the Philippines. 5. Sale of real property, location of real property. If the real property sold is located within the Philippines, the gain is considered as income from the Philippines. 6. Sale of personal property, place where the sales contract was consummated. It depends. A. Personal property produced within and sold without, or produced without and sold within the Philippines. Any gain, profit, or income shall be treated as derived partly from sources within and partly from sources without the Philippines. B. Purchase of personal property within and sale without, or purchase without and sale within the Philippines. Any gain, profit, or income shall be treated as derived entirely from sources within the country in which sold. C. Shares of stock in a domestic corporation. Gain, profit, or income is treated as derived entirely from sources within the Philippines, regardless of where said shares are sold. Q. ABC, a domestic corporation, entered into a software license agreement with XYZ, a non-resident foreign corporation, based in the U.S. Under the agreement which the parties forged in the U.S., XYZ granted ABC the right to use a computer system program and to avail of technical know-how relative to such program. In consideration for such rights, ABC agreed to pay 5% of the revenues it receives from customers who will use and apply the program in the Philippines. Discuss the tax implication of the transaction. The amount payable under the agreement is in the nature of a royalty. The term royalty is broad enough to include compensation for the use of an intellectual property and supply of technical know-how as a means of enabling the application of enjoyment of any such property or right. The royalties paid to the non-resident U.S. corporation equivalent to 5% of the revenues derived from ABC for the use of the program in the Philippines is subject to 30% final withholding tax unless a lower tax rate as prescribed under an existing tax treaty. Exclusions from gross income. Exclusions from gross income refer to the flow of wealth to the taxpayers, which are not considered part of gross income for purposes of computing the taxpayer's taxable income due to the following. 1. It is exempted from the fundamental law or by statute. 2. It does not come within the definition of income. The exclusion of income should not be confused with the reduction of gross income by application of allowable deductions. Exclusions are not taken into account in determining gross income. However, deductions are subtracted from the gross income. Construction of exclusions. Exclusions are in the nature of tax exemptions. Thus, they must be strictly construed against the taxpayer and liberally in favor of the government. It behooves upon the taxpayer to establish them convincingly. Rationale for the exclusions. There are exclusions from the gross income either because they 1. Represent return of capital, 2. Are not income, gain, or profit, or 3. Are subject to another kind of internal revenue tax, 4. are income, gain, or profit that is expressly exempt from income tax under the Constitution, tax treaty, NIRC, or general or a special law. Taxpayers who may avail of exclusions. All kinds of taxpayers, individuals, estates, trusts, and corporations, whether citizens, aliens, whether residents or non-residents, may avail of the exclusions. Rationale. The excluded receipts are not considered as income for tax purposes. Exclusions distinguished from deductions and tax credit. Exclusions from gross income versus deductions from gross income. Exclusions from gross income. It refers to a flow of wealth to the taxpayer, which are not treated as part of gross income, for purposes of computing the taxpayer's taxable income due to the following reasons. A. It is expressly exempted from income tax by the fundamental law or statute. B. It is subject to another kind of internal revenue tax. And C. It does not come within the definition of income, as when the amount received represent return or capital. It pertains to the computation of gross income. It is something received or earned by the taxpayer which do not form part of gross income. Example of an exclusion from gross income is proceeds of life insurance received by the beneficiary upon the death of the insured, which is not an income, or 13-month pay of an employee not exceeding $82,000, which is an income not recognized for tax purposes. Deduction from gross income. It refers to amounts which the law allows to be deducted from gross income in order to arrive at a net income. It pertains to the computation of the net income. It is something spent or paid in earning gross income. An example of a deduction is business rental. Difference between exclusions, deductions, and tax credit. Exclusions. Incomes received or earned but are not taxable because of exemption by virtue of a law or treaty, hence not included in the computation of gross income. Deductions. These are included in the gross income but are later deducted to arrive at net income. Tax credit. It refers to foreign taxes paid beforehand but are claimed as credits against Philippine income tax to arrive at the tax due and payable. Exclusions under the Constitution. Income derived by the government or its political subdivisions from the exercise of any essential government function. Income derived by the government or its political subdivision is exempt from gross income if the source of the income is from any public utility or from the exercise of any essential governmental function. Exclusions under the NIRC. Items that are excluded in gross income and exempt from gross income taxation. Glam as Rick. 1. Gifts, bequests, and devices. 2. Life insurance proceeds. 3. Amount received by insured as a return of premium. 4. R. Retirement benefits, pensions, gratuities, etc. I. Income exempt under treaty. 6. C. Compensation for injuries or sickness. 7. M. Miscellaneous items. 13B2 IG3. A. 13th-month pay and other benefits. P. Prizes and awards. C. Prizes and awards in sports competition. D. Income derived from foreign government. Income derived from government or its political subdivisions. F. GSIS, SSS, Medicare, and other contributions. G. Gains from sales of bonds, debentures, or other certificate of indebtedness. H. Gains from redemption of shares in mutual fund. Gift, bequests, and devices. The value of property acquired by gift, bequest, device, or descent is excluded from gross income, provided, however, that income from such property, as well as gift, bequest, device, or descent of income from any property, in cases of transfers of divided interest, shall be included in gross income. Note, the consideration is based on pure liberality and is already subject to donors or estate tax, as the case may be. Moreover, there is no income. Gift is any transfer not in the ordinary course of business which is not made for full and adequate consideration in money or money's worth, the giver is called the donor and the recipient is called the donee. Q. If Mr. Generous gave a gift to Miss Gorgeous, what are the tax implications? Answer. Mr. Generous, the donor, is subject to donor's tax, while Miss Gorgeous, the donee, is not subject to donee's tax. Donee's tax has been abolished by PD 69. The value of the gift received by Miss Gorgeous is not included in the computation of gross income pursuant to Section 32, letter B, number 3 of the NIRC. Gifts, bequests, and devices are excluded from gross income. Bequest and device. Bequest is a gift of personal property and device is a gift of real property. Both are donations mortis causa. The giver is either known as the testator or decedent, while the recipient may be the heirs or beneficiaries. Tax implication of a bequest and device. The estate of the testator or the decedent is subject to estate tax, while the heirs or beneficiaries are not required to pay donee's tax, as the same was already abolished. The value of the bequest and or the device received by the heirs or beneficiaries are not included in the computation of their gross income, since gifts, bequests, and devices are excluded from gross income. Donation inter vivos and mortis causa. Regardless of whether the donation is inter vivos or mortis causa, it is excluded from gross income, for it is not product of capital or industry. Furthermore, the property is already subject to donors or estate taxes, as the case may be. Gift, tax, test. When a person gives a thing or right to another, and it is not a legally demandable obligation, then it is treated as a gift and excluded from gross income. However, if there is a legally demandable obligation to give, such as for services rendered by one to the donor or due to his merit, the amount received is taxable income to the recipient. Q. Quiroz worked as chief accountant of a hospital for 45 years. When he retired at 65, he received retirement pay equivalent to 2 months' salary for every year of service as provided in the hospital. BIR-approved retirement plan. The board of directors of the hospital felt that the hospital should give Quiroz more than what was provided for in the hospital's retirement plan, in view of his loyalty and invaluable services for 45 years. Hence, it resolved to pay him a gratuity of $1 million over and above his retirement pay. The CIR taxed the $1 million as part of the gross compensation income of Quiroz, who protested that it was excluded from income because A. It was a retirement pay, and B. It was a gift. Is Quiroz correct in claiming that the additional $1 million was a gift and therefore excluded from income? Answer is no. The amount received was in consideration of his loyalty and invaluable services to the company, which is clearly a compensation income received on account of employment. Under the employer's motivation test, emphasis should be placed on the value of Quiroz' services to the company as a compelling reason for giving him the gratuity. Hence, it should constitute a taxable income. The payment would only qualify as a gift if there is nothing but goodwill, esteem, and kindness which motivated the employer to give the gratuity. Staunton versus U.S. Q. C is a creditor of D. The debt is condoned by C. What is the tax implication of the condonation of debt? Answer. For D, the amount is a remuneratory donation and is subject to income tax. It is not a gift because it started from an obligation and not from pure liberality of the donor. C should pay donor's tax if the amount condoned is more than $100,000. C lends D $150,000, but D failed to pay the debt. C told D that D should work in C's restaurant, and part of D's salary will be applied to the obligation. What is the tax implication there? For D, it is fruit of labor and it is subject to income tax. For C, since he pays the salary of D, it is not subject to tax. It is a deductible item. It is a business expense and therefore it is an allowable deduction. C lends $250,000, but D failed to pay the debt. D is a government employee. C told D that D's wife and daughter should work in C's restaurant and part of their salary will be applied to the obligation. What is the tax implication? The wife and daughter should pay income tax because it is fruit of labor. They should also pay donor's tax because they gave D $250,000. For C, since he pays the salary of D, it is not subject to tax. It is a deductible item. It is a business expense and therefore it is an allowable deduction. For D, there is no tax because payment of obligation is not taxable. Captain Canuto is a member of the Armed Forces of the Philippines. Aside from his pay as captain, the government gives him free uniforms, free living quarters in whatever military camp he is assigned, and free meals inside the camp. Are these benefits income of Captain Canuto? No, the free uniforms, free living quarters, and the free meals inside the camp are not income to Captain Canuto, because these are facilities or privileges furnished by the employer for the employer's convenience, which are necessary incident to proper performance of the military personnel's duties.